Welcome to Jason's Trading Bootcamp. Now, if you've ever wondered where to start, why some traders lose a lot of money trading, or simply how professionals approach these markets, then you're in the right place. My name is Jason Trades, and over the course of this bootcamp, I'm going to walk you through the same principles, mindsets, and the framework I use to approach the markets. This isn't about shortcuts, it's not about gambling, and it's definitely not about getting rich overnight. It's about learning a skill that rewards discipline, patience, and consistency. Now, if you're ready to take trading seriously, I will encourage you to subscribe to my channel and follow this bootcamp from lesson 1 through to the last lesson. With that being said, let's get into it. So welcome to August bootcamp. Today we'll be talking about the anatomy of a high probability trade. Now, one thing everyone here should know is that you could take a trade. I mean, the markets are always buying and selling, going up and down. So you could either join on any of these buses and it wouldn't be a high probability trade necessarily, right? But today we are going to learn the anatomy of what a high probability trade should look like. Now, I know most of us here are beginners, some are also advanced students, intermediate students, right? But if you're a total beginner and you don't know what Forex is, you can check my YouTube channel. I've made some videos on how total beginner traders should understand the market and all, right? So that will be posted in the group. If you are in the group too, I'll send it after this session. Now, when it comes to the anatomy of a high probability trade, under that we can be talking about the framework surrounding a trade idea, right? And the first framework we are looking at is what we call an expansion. So now let's pick that and talk about an expansion here. Now, this is what an expansion looks like typically. It could start from anywhere. An expansion can either be bullish or bearish, right? So we can have an expansion upwards or an expansion downwards. Now let's quickly take a look at the definition of what an expansion is, right? An expansion is a strong, impulsive price movement away from a level of equilibrium where the market transitions from balance to imbalance. Yeah. Now let's look at what that looks like on the chart, right? But before that, let me explain the new concepts I've mentioned. I mean, somebody here wouldn't know what an equilibrium will look like in the market, right? Now, I want us to take my whole chart. I mean, on your end, it looks like a rectangle, right? And I want us to mentally divide this rectangle and its latitude. So I'm going to use this ray tool to do that. So let's do this. Now, let's assume the area from this particular line to the top is equal to the area from that line to the bottom. So essentially, this is like 50% of the whole range, right? And that's what we call our equilibrium. Now, more reason why it's called our equilibrium is the price here, the prices we have here. So if you look at our vertical axis, you can see that we have price points, and on our horizontal axis, you can see that we have time, right? Now let's pay attention to our vertical axis. Do you realize that anything or every price above this particular line, which we call our equilibrium, is of a higher price than every price lower than that same equilibrium? Are you guys seeing that? So what I'm trying to say is that going upwards is like we are climbing up, and coming lower it's like we are descending, right? So making this point in price action, our equilibrium. Now another way to look at that is defining a range. So let's look at something like this. Let's say price is doing this. This is a simulated range. If you want to determine the equilibrium of this particular range, this is what it will look like. We want to mark with our Fibonacci from what? The low of the range all the way to the high. Now let me get the right Fibonacci settings since I don't need all this on it. Okay, so let's take this and this off. Now, I mean, if you need these Fibonacci settings, you can take a screenshot of this. Now, what this means is that in this entire range, right, on this entire range, this Fibonacci demarcates it into two zones, which is the upper zone and the lower zones. Now, these upper and lower zones will later in this bootcamp have a name, right? They have names for it, right? So for now, let's refer to them as upper zone and lower zone. Now, if you look at the price points corresponding to these zones, you realize that everything above our 0.5, which we now know is called our equilibrium, is of a higher price
relative to everything below our 0.5, which is our equilibrium, is of a lower price. So that's what it looks like. So this becomes our equilibrium. So if we get that definition, it means when price is making a sharp move from a point of balance into a point of imbalance. Now what it looks like on the real chart is this. Now let's go to the actual chart where we have candlesticks. Do you realize how price just creates an imbalance? So it has a sharp move from this particular low all the way to this high. This is the low I'm talking about. So you can see how price is expanding all the way from this low, then ending its expansion to the side. You see how this range is really big relative to other price points or reference in price points. So this is what an expansion looks like. Now the second element we are going to be talking about, or under the anatomy of a trade setup, is what we call a retracement. Now let's first get a definition before we move to the next chart to talk about it. So a retracement is a temporary movement of price back into the recently established price range following an expansion. What that means is that a retracement is as a result of what? The second leg of an expansion. So without an expansion, we can't have a retracement. So what that particular text is trying to make us understand is that first off, we have to establish that we have what? An expansion, either bullish or bearish in a particular direction. So bullish in an upwards direction, then we can have that retracement. So a retracement is them retracking their steps into a particular range, the range that's what the expansion created before, let's say, continuing higher. So after a retracement, there's always another expansion following it. So what we have here, what I'm about to mark out, is what we call the retracement phase. So expansion, retracement, expansion. It kind of looks like we are climbing some stairs. So let's look at a real chart example of what a retracement looks like. And that's what just happened here. So you can see our first phase. You can see how we are expanding right from this low all the way to this high. Then we have a retracement and we are expanding once more, right? So this phase right here, this particular price action retracking the steps of the previous expansion, is what we call a retracement. So always remember, a retracement can only occur after an expansion. So it's the second leg after an expansion. Okay, so I mean, here according to the text, we are talking about why it's important and all. So a retracement signals that the market's willingness to revisit inefficiently traded prices, rebalancing the market before continuing to the intended prices. Now I'll explain this in simple terms, but for now let's read. This move allows price to seek fair value and collect resting liquidity. Right, these are all concepts I'll be teaching in this bootcamp. But for now, let me explain what it means by willingness to revisit inefficiently traded prices, right? Now, anytime markets are making impulsive moves, they leave what we call gaps. In the future, in future sessions, I'm going to be explaining what these gaps mean or what they are called, right? So you guys can see that there are some gaps in between the candlesticks. And that's what they are talking about. So anytime market is moving from a balanced range into an expansion range or into an expansion, they create what we call an imbalance. So retracement basically covers up those imbalances. So if you can see how this retracement is covering up all these imbalances. Alright, so what do we look for in price? So they're talking about fair value gaps, liquidity voids, as these inefficiencies often act as high probability areas where price retraces before resuming its directional move. So if you look here, price retraced into a fair value gap before resuming its original move. Now, if you don't know what a fair value gap is, don't worry, just stay tuned. We'll be talking about how to identify a fair value gap in the sessions, right? Now, let's go to the next element. The next element, is what we call a reversal. Now, what is a reversal? A reversal is a shift in market direction where price moves against the previous directional bias, signaling a potential change in market structure, right? So let's look at what that looks like with an illustration. What they mean is that if market is moving in a bullish direction, a reversal would mean that they go against the original bias, which was bullish, and switch into a bearish trend, right? Hence shifting market structure. So this was the origin of this bullish move. until we got towards this point. So if we're exceeding the origin, and continuing lower, it's hinting that we have a market structure shift here. And what is the market structure shift here? It means that we are shifting from a bullish market structure to a bearish market structure. So that's what it looks like. So this is what we call a reversal. Now this can also happen in its vice versa. So market can be what, bearish, then we decide to reverse on the entire move, right? So this will be what, a market structure shift in a bullish direction. So that's what it looks like. Perfect. Now let's go to the actual chart and see what a reversal would look like. So I want us to focus on this expansion lower. So look at the origin of the expansion. I'm going to mark out the reference point. So this is the origin. This is where they got to. And I'll ask us to pay attention to this point. So let's follow the trend. You can see how price moves impulsively from this point, creating an imbalance all the way to this point. Then they start moving higher. So there's a bearish move and we have a bullish move countering it. Now, do you see how the bullish move exceeds the origin of this bearish move? Please, are we seeing that? So it's indicating a shift in market structure, or what we now know is a reversal, right? So this is where we are having our market structure shift, or you can also call it a reversal. I feel like it's safe to move on. So let me take this off. Now back to our plan. So they are asking, why is a reversal important, right? A reversal indicates that market makers have likely taken liquidity by running a significant level of stops before initiating a move in the opposite direction. This stop read often provides for strong repricing phase. Now all this, you'll be understanding it, it's in levels. You'll be understanding as the mentorship goes on. Why do I keep saying mentorship? Bootcamp keeps going on, right? So we'll be talking about liquidity. We are going to learn who the market makers are. We are going to learn what stops are and everything, stop rates are. So don't be scared by new words. Now, what do we look for in price? Liquidity pools resting above previous swing highs and previous swing lows are areas often contain the stops that follow the next significant move, right? Now we can explain this with our chart here. Let's just go here. What they are saying is that above every swing high or above any prominent high you are looking at, since this was the origin of this bearish move, we have what we call liquidity lying above here. So let me get two to illustrate it. So we have liquidity all above this point. That's what they are trying to say. So the market reversing and hunting, or like moving towards that particular direction, is trying to hunt or read the liquidity above here. Now, the way you predict a reversal is first noting an expansion. So I was talking about what the first leg of a reversal being an expansion. Now, if price is moving rapidly against the original directional bias, right, that's where you can anticipate a reversal, right? I'm not using the word predict because we don't predict in Forex, we anticipate, right? So yeah, that's what it looks like. Let's go to the next element, which we call our consolidation, right? Now, what is a consolidation? A consolidation is a period where price trades within a defined range, showing a temporary balance between buyers and sellers without a clear commitment to move higher or lower, right? So let's go to the chart and demonstrate what a consolidation looks like typically. Now, according to the definition, it's moving in a defined range, right? So let's have these two rays here. So price is moving up and down. They don't really have a defined directional bias yet. So they are just bouncing on and off to specific ranges, right? So this is what they are trying to talk about. So they are bouncing off this high and they are bouncing off this low. So price doesn't have any real direction yet. We don't know who's in control, whether the buyers are in control or whether the sellers are in control, because they seem to be moving up and down. Right, and one tip I'll give you is that anytime you see price entering a consolidation, it's safe to stay away because the next move is going to be big, right? We'll be learning about that in future sessions. So now let's look for an example of a consolidation. Do you guys see how price is bouncing up and down these two ranges? So you can see how price is just moving inside this range. And after, do you see how price breaks out and makes a very impulsive move before going higher? So that's what a consolidation looks like. There are more examples. I think this is another typical example, and even better example. Look at how many times price rejects off this particular zone and how many times it also rejects off this lower zone here. Perfect. That's what a consolidation looks like. Okay, so the next question is, why is it important? Right? Now, when price consolidates, it indicates that market makers are allowing liquidity and orders to accumulate on both sides of the range. This build-up often creates the conditions for the next significant expansion move. So I think we proved that. Let's go back to this. Let's draw it again. So you can see how market is bouncing off this zone. Market is also bouncing off this zone. Now after the accumulation phase, do you see this expansion going higher? So that basically adapts to the definition we just got. I mean, it's trying to explain what a consolidation is. The next question is, what do we look for in price? The impulse swing away from the equilibrium level, which is typically located at the midpoint of the consolidation range, is revealing the next direction of the next potential expansion. So what they mean is that this particular two zones, we want to define the midpoint. So we can use our Fibonacci for that. So let's mark from this zone all the way to this zone. So you can see above the midpoint of this particular zone, price is expanding. So it clearly indicates that we want to go higher from here. So you can see how they went higher from that point in price action. That brings us to the end of today's lessons.